Hello friends, welcome to one more video on NISM-Series-XXI-B Portfolio Managers Certification Exam. By now I have created multiple videos on this particular exam. In fact, I have created one video in the past on this particular topic also. But this time I am going to include more questions in this particular video related to chapter 14, which deals with behavioral finance. The reason is that on behavioral finance topic, you need to know multiple concepts and you need to know different types of biases and cognitive errors that an investor makes, okay, while making investment. So this chapter, according to me, is very technical in nature, not in terms of solving a numerical, but in terms of understanding the nuances of behavioral finance. Let me quickly start with the questions that I have covered in this chapter so that you can work along with me. So the first question is belief that a high profile manager is equals with a better managed company, and that makes good investment, right? So what happens is we tend to have such beliefs, right? When we look at a good company and high profile manager, we believe that that will result into a good investment, right? So let us go with this particular company, right? This kind of bias, if we have, it is in the behavioral finance world, this is called as simply the stereotype bias, right? This is nothing but stereotyping. Basically, you are just getting influenced by the fact that there's a high profile manager, there's a company, so everything has to be fine, right? So we will call this as, in simple terms, as stereotype bias, right? The answer is A here. Okay, so let us move further and let us see, as I said, the answer will be A here. So let us move to question number 2. Dash dash dash, which is fill in the blank, is an emotional bias in which people value an asset more when they hold rights to it when they do not hold it, right? So we will call this simply as the one word, which is what we define as the endowment bias, right? This is called as endowment bias in behavioral finance. Yeah, there's a discussion on this particular bias in the chapter also. Which of the following bias leads to misguided conviction and often blurs the difference between skill and luck? Many times in life we are just lucky, but we feel we are very skillful, right? You buy a share, you make good money, and then suddenly you realize, oh, this is because of your skill, but actually that could have been just because of your luck. If you have such biases, we'll call it as overconfidence bias. This takes us to the next question. Employers used nudge, okay, so that employees can enroll for pension plan, okay, which resulted into higher enrollment for pension plan. Many time in our life, we just need that small push, right? We are not doing something, we are not ready for something, but there's a nudge, there's a push, right? And we get convinced about that. Which of the following bias was taken care of by the employee? This is called as the status quo bias, right? You don't want to move away from status quo, you just want to be comfortable with that, but then you get that nudge and you accept it, right? Which of the following is not the feature of overconfidence bias? Okay, people rate themselves better than average in their skills, expertise, and knowledge. Absolutely, this is core of overconfidence bias. It results in underestimating losses. Absolutely true, because you are so confident that you're not ready to underestimate the losses. This unwarranted confidence often leads to suboptimal decision in investments, which is also true. But what is not true is because of overconfidence bias, investor build diversified portfolio and do limited trading well. Anybody who has overconfidence will not build a diversified portfolio, because diversification essentially means that people want to protect against risk, right? They are not confident, correct? So this would be the answer, which is the answer D here. So we'll go with D, which is not true. It takes us to the next question. Find out the wrong combination. Now, these are the theories, or these are the concepts which have been developed in behavioral finance. Bounded rationality was developed by Herbert Simon, which is true. Prospect theory, Daniel Kahneman and Amos Tversky, which is true. Disposition effect by Sheffrin and Statman, which is true. But mental accounting was developed not by Harry Markowitz. In fact, Harry Markowitz is the person who is given credit for portfolio theory. The answer here would be Richard Thaler. Richard Thaler is the person who developed mental accounting. So this becomes the wrong answer. Question number 7. Which of the following is not true about cognitive errors? Cognitive errors are different from emotional biases. We have cognitive errors and we have emotional biases. We need to understand the difference between the two. So cognitive errors are statistical information processing or memory errors that cause a person to deviate from rational behavior, which is absolutely true, right? It's more quantifiable in terms of our decisions. Emotional biases are not easily quantifiable. They are more about expressions and all that, right? Cognitive biases result from reasoning influenced by feelings. No, cognitive biases are not about feelings. So this would be the answer. However, just for information, people are less likely to make cognitive errors if they remain vigilant, which is absolutely true. And cognitive biases can be considered as a shortcut approach to decision making, where one avoids going through the pains of analyzing and evaluating options. Well, if you analyze something in detail, okay, you will be able to remove or reduce cognitive errors significantly, but not if you apply a shortcut. So this is quiz number 7. Quiz number 8 is the treatment of salary income different from the tax refunds and bonus amount is an example of which of the following cognitive errors. Remember, in our life, we treat different incomes differently. When you get a bonus, you spend it, and you are not that concerned about it's getting disappeared from your bank account because you have spent. But salary spend will pinch you more. So we call such things as mental accounting. Mental accounting is part of behavioral finance, and it is part of cognitive errors, right? The next statement, which is dash dash dash, is a bias and information bias is an information processing bias in which a person answers a question differently based on the way it is asked, right? Many times 0% fat and 100% fat free, they are the same thing, right? If somebody tells you 0% fat in a food and 100% fat free, you may respond differently to it, right? That similar thing happens in investments also, right? So we will call this as framing. The way question has been framed, right, that will influence your decision. The question number 10 is, which of the below is not the step involved in decision making as per bounded rationality? Now, bounded rationality is one of the core principles of behavioral finance, right? So process only information which is manageable, okay? So that is what is your bounded rationality. You are, there's a restriction, there's a limitation that has got created. Rule or thumb or quick approach are applied while processing. Yes, that's easier, that's convenient, okay? This is backed by extensive research and working on alternatives. Well, that cannot be the case. So this is something which is wrong. And then we have satisficing solution, which is combination of satisfactory and sufficient, which is true. Quiz number 11, which of the following is not true about traditional finance? So traditional finance is based on certain assumptions. So we are testing those assumptions here. So the first question is, investors are rational, which is what is traditional finance saying? Behavioral finance says bounded rationality, right? Investors are risk averse. Absolutely. That is what is also said by traditional finance. Investors are self-interested utility maximizers. Okay. That is also true because the marginal utility and diminishing marginal utility and equimarginal utility are core of traditional finance. Investors never update their belief and stick to it what they believe in. No, 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 no. This cannot be true. So this is wrong. Question number 12. Which of the below mentioned statements about market anomaly is true? Are true. So market anomaly is something which exists. Which are the statements? Let us evaluate them. Behavioral biases may cause investors to make systematic mistakes when they invest, and those mistakes create anomaly in the market. Absolutely. Disposition effect, where investors hold on to losses longer and sell thinner faster, explains momentum in prices, which is also true. Under self-attribution bias, investors tend to take credit for success and blame others for failure. Okay, they follow information that supports their belief and disregard conflicting information. These biases may cause investors to trade too often. So all A, B, and C are true. So this will be all the above. But what is it that you get to know from this question? You get to know the concept of market anomaly. So please do read about it. Sometimes there are questions around this in the exam. Question number 13. Research suggests that investors extrapolate uptrend with their positive feedback on an asset. If this extrapolative expectation is widespread, it results in herd trading. Herd trading overcomes rational intervention. Now, if that happens, which of the factor is this which results into bubble getting created? So as per the behavioral finance theory, bubbles get created because of factors such as liquidity, celebrity status, momentum, illusion of control. This example is an example of, simply said, momentum. So what are we focusing on? We are focusing on momentum here. So this is the example. Question number 14. Which of the below mentioned statement is not true about behavioral finance? So the previous question we tested about traditional finance. Now it has come to behavioral finance. Risk return trade-off is foundation of investment. Psychology is at the core of it. Decision making. Decision is ad hoc based on thumb rule. Decision making is consistent given with experience, recency or loss aversion. Well, risk return trade-off is the foundation of investment is something which is wrong. So this is not true about behavioral finance. We go to question number 15. Which of the following combines value growth phenomena from fundamental investing and momentum effect from behavioral finance? This combination is what is called as fusion investing, not contrarian, not fundamental, not total. So this video I have prepared 15 questions. Please go through these and the related concept. Also make a list of all the concepts of this chapter so that you can get full marks when questions related to this chapter are asked. Thank you for your valuable time. Plus, please do not forget to subscribe to this channel and like this video. Tell your friends also to do the same. Thank you so much.